Hi, this is Brent Johnson with Santiago Capital. It is now January 2018. Another year has come and gone, and the year ahead looks to be a memorable one. Gold made a furious rally the last 2 weeks of the year, following the Fed's third rate hike in 2017. So much so that it is now threatening to definitively break out of its 6-year channel to the downside. Now, I'm the first to admit that this rally of this size caught me a bit off guard. I thought we might rally to test the underside of this red resistance line after the Fed hike, but was not expecting it to run right through it. But now that we are here, is this it? Will we finally be able to put the bear market to rest for good? Well, there's a big test ahead in an area that has previously provided strong resistance. So what do we look at to determine the likelihood of a further breakout? Well, perhaps the most ingenious thing of all when it comes to gold is that it doesn't do anything, doesn't yield anything, doesn't report earnings. It just sits there and endures. But it does react to the world around it. Currencies, interest rates, equity markets, government policies, investor confidence. But at the end of the day, I consider gold to be the ultimate form of money, and as such, I think of it as a currency. And because I think the dollar is its biggest competing currency and one of its biggest influences on it, I'm going to focus on that the most. I'll also touch on Europe, Japan, and China, and finally the US markets before getting to what I expect from gold. In my last update, titled Psycho, I talked about how everywhere I looked, it seemed that people were losing their minds. Trump derangement syndrome seems to be the biggest catalyst for this manifestation of insanity. And unfortunately, this sickness doesn't seem to be going away. Whether it's the people so crazy in their belief that Trump is going to make America great again, that they can't see that there's a clown sitting in the Oval Office, or whether it's the outrage felt by the never-Trumpers who see the president as the antithesis of what made America great to begin with and long for the days of the perfect president lording over Camelot to return. Never mind the fact that JFK cheated on his wife and secretly acquiesced to the Russian demands to remove U.S. missiles from Turkey. But that's a story for another day. But regardless of where you come down on this, the bottom line is that it appears to me that there's a mass psychosis has descended upon America, and we need to be injected with a treatment before it's too late. From a capital market standpoint, interest rates are the cause of much mental instability. Because interest rates haven't actually risen in over 40 years, many are convinced that doing so now will be the cause of another financial crisis. And with stocks at all-time highs, many seem eager to call a top. And this concern is bleeding its way into the dollar. After a big move from 2014 to 2016, the dollar fell 10% in 2017. Many are convinced that it's going to go much lower in the years ahead, and I must admit, the chart doesn't look super encouraging right now. But that said, I do disagree with the bears. I have not given up the dollar bull thesis. So while the dollar bears think I need to come back to reality, I still believe in the years ahead that people are going to marvel at the strength of the dollar as it rushes towards all-time highs. And I'm going to show you why higher interest rates are not necessarily a death knell, and may in fact be a blessing in disguise. So I think Marvel is a very fitting title for this presentation. Since no one seems to be able to believe the world that they are looking at, we may as well look at the world through a lens of make-believe. Marvel has been a publisher of American comic books in one form or another since the 1930s, and was acquired by Disney in 2009 for $4 billion. There's nothing in the world my son likes more than to read Marvel comic books and watch Marvel movies, so I've learned a lot about superheroes in the last few years, whether it be Iron Man, the Black Panther, Doctor Strange, or Spider-Man. Now, the origin stories are always pretty interesting. Sometimes, like Thor, they're born with their powers. But Peter Parker received his after being bitten by a radioactive spider, and David Banner received his after being exposed to gamma rays. But in a not uncommon scenario, superheroes are often created in a lab by some arrogant PhD who has a crazy idea about either saving or taking over the world. Wolverine is an interesting example, because he was born with mutant strength and regenerative powers. But before he was one of the most popular members of the X-Men, the US Army injected adamantium into his bones and turned him into Weapon X. Now here's a bit of Marvel trivia for you. Most people think the X in Weapon X stands for X-Men, but it doesn't. It actually stands for Weapon 10. So who was Weapon 1? Well, the same U.S. Army first injected super soldier serum into a skinny kid from Brooklyn named Steve Rogers, who from that day forward became known as Captain America. First released in 1941, he was Marvel's most popular character throughout World War II. He also stands as a testament to that the U.S. knows how to employ propaganda as well as any of our enemies. But almost as soon as Steve Rogers was injected, the U.S. Army's archenemy Hydra stole a sample of the serum, and their leader injected himself with it, where the side effects turned him into the Red Skull. But back to present day. Most of the economic, monetary, and political decisions of the last 10 years were all made with the intention of maintaining the status quo, or at least the appearance that everything was fine with the status quo. After all, appearances are important and go a long way towards protecting confidence in current leadership. As the saying goes, it's better to look good than to feel good. And I suppose most people can relate to this in some form or another. On a personal level, many of us totally understand the desire to maintain our own status quo, whatever the pain and whatever the price. For a long time after the global financial crisis, global monetary policy was a coordinated effort to maintain stability and order in the financial markets. And as I've explained many times before, in order for our monetary system to remain stable, one of two things need to happen: either a flow of capital or injection of new stock. So in our crisis, we turned to these wannabe superheroes and told them to save the world, and they were arrogant enough to accept the job. Because the credit crisis had ground the economy to a halt, there was no natural flow of capital. So our superheroes grabbed their weapons, in this case monetary syringes, and set off to inject liquidity and build up the monetary stock. They did this by targeting interest rates. By pushing down on their plungers, they pushed down interest rates. Out of these syringes came dollars, yen, yuan, pounds, and euros, and in an effort to make their domestic markets liquid and attract capital investment. But in today's global economy, capital is not limited to domestic markets. It flows around the world to where it's most wanted. So rather than just injecting liquidity into the businesses within their own national borders, they flooded the entire globe with one giant sea of liquidity, a monetary milkshake, if you will. So where does all this money go? Who gets to drink the milkshake? To find that answer, I'm going to ask you some questions, and I'm going to use this fictional city as a setting for our demonstration. Now in this city, there's 9 banks that you can choose from. How do you pick where to put your money? Well, let me give you a little bit more information. These 4 banks have a history of bankruptcy, and they also have limited liquidity, meaning you can't always withdraw your money on the day you request it. These 2 banks have great liquidity, but they don't pay you anything on your deposits. These 2 banks have good liquidity, but they actually charge you while they hold your money to make loans, pay their employees, and buy other assets. But this bank, in the middle of town, with the most foot traffic and great liquidity, pays more than any of the other banks. In addition, many people in town have loans from this bank, so they already need to deal with them from time to time in one form or another. Now, I don't think I've said anything too controversial so far, and I don't think it would be such a stretch to say that it is likely that this bank, with the best liquidity and the highest return on your deposit, would be one of, if not the most popular banks. And I would expect many people in town, regardless of where they lived, to agree. And as such, this bank would attract the majority of the deposits. Now, if we were to change locations, do you think this would change people's behavior? Regardless of what city do you live in, don't most people search out the best options? Well, let's see. Let's leave that location, and instead, let's go to this one. Now, this location is a bit bigger than our previous city, but the circumstances are basically the same. These 4 have a history of bankruptcy and capital controls. These 2 offer good liquidity, but they don't pay you anything on your deposit. These 2 are very big and offer good liquidity, but they charge you to hold on to your money. Meanwhile, this one pays more than any of the competitors, has better liquidity than any of the other banks. It also does lots of businesses with the other banks and has extended loans to many of them. Furthermore, it just set up a number of tax incentives to make your deposits there even more profitable. Is it really such a stretch to believe that customers from around the world are going to send their deposits to this bank? And this is why I think in the years ahead, capital is going to flow into the dollar. Sure, it has many problems, but on a relative basis, it looks very, very good. What's that you say? Corporations aren't going to move their money here because they are instead going to move to the yuan? If that's the case, why is China worried about the new tax plan? Why has China expressed concern? Why are they developing plans to counteract this flow, if this flow isn't going to happen to begin with? Finally, if China is not worried about capital flowing from China to foreign markets, then why do they have capital controls in place to limit withdrawals? Oh, Europe? The euro is definitely on a roll, and as such the corporations are going to leave their money there? If that's the case, why is Europe worried? If it doesn't hurt them, then why doesn't Europe like our tax plan? If corporations are so excited to keep funds in Europe, then why is the EU considering challenge the US tax plan with the World Trade Organization? Furthermore, if Europe is such a great corporate environment, then why is everyone worried about their most recent and maybe most ridiculous regulation yet? MiFID II is creating a nightmare for banks and financial corporations who are just now coming to grips with how restrictive this new regulation is. And finally, if foreign banks and corporations are not interested in parking cash in the US, then why do so many do it already? Why do half of the cash deposits at the Fed belong to foreign banks? Pretty strange, huh? So after capital flows, another big argument causing people to lose their minds and bet against the dollar is that despite the Fed's plans, they won't actually be able to raise interest rates without causing a recession. Never mind that they said the same thing when the Fed initially talked about tapering QE, when they talked about stopping QE, when they raised rates once, then twice, then a third time, and finally a fourth time. Apparently this time, the fifth time, they really mean it. To further this argument, many will say that not only is the Fed not going to be able to raise again, but more likely than not, a return to stimulus, or QE4, is right around the corner. Now I'm going to explain to you why I think this is wrong, and why I don't think QE is coming back, as well as why we don't need it to come back. And the reason is because it never left to begin with. Let me explain. In the same way Captain America's injection took place in New York, America's QE program was operated out of Manhattan by the Federal Reserve Bank of New York. But even though it operated out of the East Coast, it wasn't limited to that geographic area. Injecting the economy provided liquidity that helped Florida, Texas, the West Coast, as well as the Midwest. But remember, Hydra stole the super soldier serum and took it back to Europe, so they know how to do this too. And as we discussed earlier, capital flows are not limited to domestic markets. Money travels to where it is most wanted. And we had the same operation with the same injections taking place in Europe. Not only that, but it's still happening today. And there's nothing to guarantee that that liquidity stays in Europe. It can flow all over the world, and it can easily flow into the US. One other thing to know about comic books, many times, the villains are nothing more than mirror image of the heroes. For example, there's Spider-Man and Venom, there's Captain America and the Red Skull, or there's Hulk and the Abomination. The same goes for our monetary stimulus. So far, we've shown the funds flow from right to left. But there's no reason it can't flow from left to right. The mirror image will work just as well. And this is where the Silver Samurai comes in, a mutant with the power to heat up his adamantium katana sword. He was based out of Tokyo, which also happens to be where the Bank of Japan is headquartered as well. They've been injecting stimulus for longer than anyone, and the yen carry trade has provided as much liquidity to the global markets as anything else. The point I'm trying to make is that this is a global game, and QE is still here, because it never left. Despite the injections taking place in Frankfurt and Tokyo, rather than New York, the markets are still being flooded with cheap capital, and US has the opportunity to get this capital. So even if the Fed continues on with its plan to reduce its balance sheet, global central bank balance sheets are not shrinking. In fact, they're still expanding. In a global economy like we have today, it doesn't really matter who's injecting the QE. What matters is who's capturing the QE. And this is where my favorite Marvel character of all comes into play, Magneto. Arch rival of the X-Men, He can generate and control magnetic fields at will. All he has to do is raise his hand and he can attract metal to him. Remember our superhero central bankers? The ones flooding the world with the currency milkshake? Well, Magneto is about to kick their butts, because all the U.S. has to do is lift up their plungers, which will in turn raise our interest rates, and all that global capital will be immediately attracted to us. After all, if we go out for milkshakes and I'm the only one who has a straw, guess what happens? I drink your milkshake. That's what happens. So even though the Fed is no longer contributing to the supply of milkshakes, we are getting the flow of milkshakes, and that is even better. It might not show up today, it might not show up tomorrow, but over the next few years, the dollar is going to get fat by drinking the rest of the world's milkshake. So once people see that capital flows may occur and that rates may rise, their next argument for why it can't continue is that the yield curve will invert, and that will throw us into a recession. Okay, there's some truth here. In a normal world, the yield curve should not invert. You should get paid more for investing longer out into the future to compensate for the increased time risk and lower liquidity. And that's what a normal yield curve shows. An inverted yield curve shows that many are worried about the long-term ramifications of the short-term speculators driving current markets to extremes. And sure enough, this usually leads to a recession as the irrational exuberance of the short-term speculators is washed away. So what happens in the short term? Does this mean stocks are going to crash? And if so, when? Well, let's look at another time period where this happened. And since many are warning of another crisis, and maybe even another 1929, let's look at the 1920s. The Cleveland Fed put out a great report about this exact subject titled Interest Rates in the 1920s. In this report, they show short-term rates and long-term rates, which are the chart on the left above, as well as the yield spread of the 10-year rate and the 3-month rate, which is the chart on the right. What this clearly shows is that from 1927 to 1929, short-term rates not only rose, but they more than doubled in just 2 years. It also clearly shows that the yield curve inverted and stayed this way for an extended period of time. Now, prior to 1927, the stock market had been on an incredible 5-year run. Over that time period, the stock market increased by 200%. Markets were euphoric. After all, they didn't call it the Roaring '20s for nothing. Now, it would not shock me to learn that some people may have noticed this euphoria and warned against these excesses and pulled their money out of the market. They may have even correctly predicted the yield curve would invert, and as a result, fearing a recession, bought U.S. Treasury bonds. How would that have worked out? Well, from the beginning of 1927 through October of 1929, the stock market more than doubled again. What happened to Treasury bonds over that same time period? They lost 30%. Now, I'm not being cavalier. We all know what happened in 1929 and what came afterwards. Had that guy who bought those Treasury bonds held on long enough, they came back, while equities went through a decade of decline. But my point is, in the short term, rising rates and an inverted yield curve don't mean a recession is imminent. In fact, while it lasts, it's extremely inflationary. And that's where I think we are headed today. Now, let's move on to the supply and demand aspects of the dollar. I'm not going to spend a lot of time on demand other than to point out that the dollar, despite all its flaws, is still far and away the most dominant funding currency in the world. Almost everyone, all over the world, uses it to some extent. And because they have used it for funding, they can't ditch it without first paying off the debt associated. Speaking of dollar debt, let's take a quick look at how much dollar debt there is in the world. Now, these numbers are approximate, but they're very close to reality. We've got $16 trillion in net U.S. national debt, another $10 trillion in the U.S. banking system, another $10 trillion in dollar debt issued by entities outside the United States, and the Bureau of International Settlements calculates as there's another $13 trillion of off-balance sheet debt in the world that adds up to an almost $50 trillion in total. If we were to assume that all of this debt was borrowed at the average rate of the outstanding U.S. Treasury, or 2.3%, that means that there is over $1.1 trillion in dollar demand every year just to service the dollar-based debt. And I think we all know that that's not the true rate. It's probably double that. Bottom line, it doesn't matter if the dollar is preferred or not. What matters is that the dollar is owed. Lots of it. So the dollar's not going anywhere anytime soon. Now, as mentioned earlier, the dollar fell 10% last year. This doesn't happen if there's no liquidity. So where did all this liquidity come from? Well, because they bumped up against the debt ceiling last year, the Treasury couldn't issue bonds. So instead, they spent their available cash, almost $400 billion of it in Q1 alone. In other words, rather than taking in cash from the markets, they were pushing cash out into the system, flooding it with dollar liquidity. And through a number of various extensions and extraordinary measures, they funded the government up until now. But once the debt ceiling issue is kicked down the road or eliminated altogether, we are going to have the exact opposite situation of last year. Because the Treasury is not just going to issue new bonds, they are planning to ramp up new issuance in a big way. Now, I often hear that this is bad for the dollar because it increases the national debt. And in the long run, this is true. But in the short term, it means the biggest player in the world is now competing with other market participants for the dollars that are already out there in the system. They're not printing new dollars, they're exchanging debt for the dollars that already exist. They're buying dollars. That's a lot of demand. So now let's quickly talk about Europe. There are so many problems here, it's hard to even know where to start. In very simple terms, the euro is ultimately doomed to failure for two reasons. There is no common debt, and there is no common army. The EU leaders know this is crucial, so they will float these ideas in headlines from time to time in order to give the appearance of it being a possibility. But this is all just a bluff. The Germans have made it very clear that they don't want to pay for the pensions of tax-evading Greeks. Now, do you think Greek men are going to turn around and fight in a war to protect German business interests? And this is just one example. The idea of Europe all working together as a team is a marvelous idea, because teamwork can lead to incredible things. Just look at the Fantastic Four. Johnny Storm, Reed Richards, Susan Storm, and Ben Grimm worked great together as the Fantastic Four. They were hard to beat. But Europe does not have the Fantastic Four. Instead, they have the four Bs. Berlin, who can't form a government. Brussels, who's so out of touch they make Hollywood look down to earth. Barcelona, who wants to get out. And Berlusconi, who wants to get back in. Are you kidding me? Forget winning. These four make it hard not to laugh. That said, the euro has been on a heck of a run in the last few months, and it looks like it wants to at least test its long-term resistance at the 125 level. This surge is evidenced by the fact that the spec longs in the futures markets have never been higher. When I look at this graph, I just have to shake my head. This spec positioning may very well get bigger, but it will end in tears. I expect this resistance to hold, and even if there's an overthrow for a couple weeks or months, I don't think it can last. As the dollar drinks Draghi's milkshake, I expect the euro to trade back to par with the dollar before falling even further. As for Japan, well, they've been doing QE for so long, I'm not even sure if they know whether the patient is even alive or dead anymore. So to me, they're like the Ghost Rider. They made a deal with the devil and pushed on the accelerator. The yen is working its way towards a very decisive end to a wedge that's been forming for the last 6 years. It appears this will come to a head sometime in 2018. And I don't think there's any way the Bank of Japan lets this get resolved with the yen breaking to the downside here. The Ghost Rider's deal with Lucifer was for eternity, so they are not going to back off now. Speaking of eternity, I love long-term charts. And this 30-year chart of the yen does not disappoint. Once it breaks out of this wedge, there is only one more level of resistance at around the 120 level. When the dollar bull finally gets into full swing, I will not be surprised at all if we revisit the highs in the yen from 30 years ago. Now we come to China, what seems to be everyone's favorite superpower. When I hear people talk about China, it's almost as if they think their population looks like this. 1.4 billion superheroes, who can crack any code, solve any riddle, and basically do the impossible. In fact, if China said they had changed the laws of physics, I'm sure many would agree. So I'm going to equate them with Marvel Boy. Born in New Jersey but raised on another planet, he had magic wristbands that allowed him to manipulate both gravity and light. Pretty cool, right? Well, not only that, but he traveled around the galaxy in a rocket ship named the Silver Bullet. And here's the thing. I understand why China is such a marvel. It's absolutely incredible what they've accomplished in the last 40 years. And as I look forward to the next 40, I'm sure they will come to dominate the world, and their One Belt, One Road initiative will eventually come to pass. It's basically their manifest destiny. But let me tell you something. They are not gods. They do not have superpowers. And they do not have a silver bullet that will allow them to walk out of the impossible trinity without any scratches. China's rate of growth has been incredible, but it has come about as a consequence of the greatest bubble in history, the greatest credit bubble in the history of mankind. And they need to borrow another $20 trillion over the next couple of years just to hit their 2020 GDP goals and keep the show going. Marvel boy indeed. But believe me when I tell you, they are really going to need those magic bracelets. And that brings us to the US markets. The Dow was up another 25% in 2017. When will it end? Well, it traded within a pretty well-defined channel for most of the last 8 years before finally breaking out to the upside in the middle of last year. And then it broke out of an even steeper channel later in the year and rallied across the $25,000 level for the first time ever. So, it's due for a crash, right? Well, I'm not so sure. Now, could we use a correction and take some of the froth out of the market? Sure. I would actually love that. I think it's needed, and I think it would be healthy. But I'm not sure it's going to happen. And even if it does, I don't think it will lead to a crash or a recession. Not yet. I think equities melt up in the next few years as the knock-on effects of the dollar drinking the rest of the world's milkshake take place. And part of the reason is this chart right here, the 35-year bull market in treasuries as yields have fallen. It goes by many names, the most important chart in the world, the chart of truth, etc., etc. And part of the reason I think that the markets melt up is that I think this is the year the 35-year channel and the 10-year rate breaks to the upside. Now, a lot of very smart people, a lot of them my friends, and many people I respect greatly, think the bull market and fixed income rolls on, and rates are still headed lower for longer, and maybe even negative. But I don't think so. I think this is the year it ends. It's knocking on the door right now. Now, whether we go through right away, or whether we need to take a breather before making another attempt, I don't know. But in my opinion, this is the year the rates finally break out. One of the things that I think will help with this is the velocity of money. It has been falling for 2 decades now, and for a long time it showed no signs of slowing down. But then, suddenly last year, it made the slightest of pauses, and then it actually turned up. Now let's not get crazy. When I say it turned up, what I really mean is it didn't fall. So this is very early. But we get another reading in a few weeks, and I think it will be higher still. Now, velocity is a component of inflation, and the last couple times we've tested the breakout level on this inflation indicator, there wasn't much velocity, if any, to help it break through. I think this time it has a shot. And the thing about inflation is that it can look like it's stationary, but before you know it, it's running away from you. Kind of like my son's favorite superhero, Quicksilver, the fastest guy in the world. If he gets out ahead of you, it's almost impossible to catch up. And that brings us back to gold. How is it going to react to all of this? Well, the relative strength of gold is historically high right now. And while I'd prefer to buy gold when it's beaten up and the RSI is low, a high RSI is not such a bad thing. After all, it is a measure of strength. Now this is a price chart of gold with the DSI overlaid on it. This daily sentiment runs from 0 to 100. As you can see, it's currently at 88. This is the second highest reading of the entire bear market. And the last 5 years have shown that it is not wise to buy any time the DSI is at these levels. It just simply overbought here in the short term. Now, is this time different? Maybe. But it's my experience that when people invest thinking this time is different, it usually doesn't end really well. Now, this is a chart of gold overlaid on the futures positions by the commercial futures traders. This chart clearly shows the inverse relationship between the gold price and a commercial short position. Also, the data here is over a week old. and I estimate that the real-time commercial short position to be down at this level, which is again approaching the extremes we saw in 2016. The bottom line is, the potential upside from here is falling fast, and based on the last 5 years, this is not a good place to enter a gold trade. So, does this mean that gold is going to fall? No. It just means the conditions are not ideal for a breakout at this time. Combine this with the fact that inflation signals starting to heat up, which could draw the dollar higher, and the equity markets pushing all-time highs. I think it's very possible the Fed surprises the markets and raises rates at the January meeting. So with that as a backdrop, and while I think it's very possible we move further up into the resistance overhead, I think odds are good that we'll get another pullback before a definitive breakout. Even if the dollar is destined to go lower, it's overdue for a nice rally, and that will also act as a short-term headwind for gold. So I think we'll pull back to at least this level here, where we previously resistance can now act as support. And maybe even into here, where some stronger support resides. Bottom line, I'm not chasing gold here. I think there will be a better opportunity in the months ahead. Now, I'm not suggesting to you that you sell your gold and move on. I'm just saying that we still need to be patient. Eventually, dollars and gold will rise together, but we need to let the dollar make its initial move first. Now, is it possible I'm wrong and the gold is now charging for its definitive move? Of course it's possible. And if that happens, I'm going to look like the dumbest gold bug in history. I might not look quite as dumb as the wizard who developed super speed after a transfusion of mongoose blood, but pretty dumb nonetheless. But once we do finally break out, whether it's this time or the next, I expect a very long and profitable bull market in the years ahead, where price literally goes off the charts. So I guess there'll be some time to make up some lost ground. That being the case, I'll stick with my call that we are not yet ready to break out. It's not easy, but if markets were easy, we'd all be superheroes. Now, I've been saying for a couple years now that this crazy market game progresses and confidence eventually falls. The dollar and gold will rise together. But we're just not there yet. The dollar and the Dow will rise as the U.S. drinks the rest of the world's milkshake. People will marvel at the heights achieved in each of them. Eventually, dollars and gold will be the last two men standing in this epic battle of currencies. The world will shake. And when the whole world shakes, a superhero will show up. Because the Avengers were not there to save a kitten from a tree on a random Tuesday in January. They were assembled to save the world when it was in serious danger. And gold is nature's superhero. It can't be created with a syringe, and it can't be destroyed in an epic battle. It will survive a deflationary collapse or an inflationary nightmare. Booms, busts, revolutions, and war. Gold doesn't care. It just endures. And it will be the last man standing when our monetary Ragnarok finally arrives. Just buckle up and hold on. If you're still with me, I appreciate you taking the time to hear my thoughts. As always, if you'd like to discuss in further detail, I can be contacted by the information provided on this slide. All the best in 2018. Thanks for listening.